Good day, traders. In today's video, we'll be talking about market structure. Remember, this is Remit Trade Academy, home of successful traders. And if you've not subscribed to the channel, ensure you do that and help turn on the notification bell and hit that like button for your guys. So, without further ado, let's get into what we have for today. Market structure. When you first of all look at a particular financial market, the first thing you do is not looking for a particular candlestick pattern before you place a trade. It's not also looking for chart patterns before you place a trade. Or you try to look at, peaks and bottom. No, the first thing you look out for before you place any trade in the financial markets, any financial market at all, is you seek out or look at the market structure. Look at what the market is doing at that particular time, under that precise time frame. You'll be looking at H1, you'll be looking at H4, D1, and W1. It does not matter. But the first thing you must do to ascertain what the market is doing is looking at the market structure. So we have three types of market structure in any financial market. So in this case, we're focusing on the cryptocurrency market. We have three types of market structure. Number one, we have uptrending market, we have downtrending market, and we have sideways market. Now, in this video, we're going to go through step by step each of these market structure and how you can apply it in any market condition and how you can take advantage of the different market structure we have to your own advantage. Uptrending market. Now, what is an uptrend? An uptrending market, this is a type of market, that is financial market, is characterized by a series of higher highs and higher lows. So you see, before you say a market is trending up, you must see higher highs. So you call higher highs HH and higher lows HL. Okay, so when you see series of higher highs and higher lows, we say that market is trending up. That market is trending up. Let's say, for example, you say this is a hallmark of an uptrend. See, market move from here, market move up, a higher high. This high is higher than this low, so it comes back down from a higher low. It moves up, higher high, goes back down, higher low. Remember, this is a higher high because it's higher than the previous high. Now, this is a higher low because it's higher than the previous higher low. Very important. Now, this move up again from a higher high, higher than the previous high, comes back down, that is retraced down from a higher low, move up again, higher high, comes back down, higher low. When you see a series of higher highs and higher lows like this, then you can say that market is trending up. So that is the characteristic. So when you look at a particular financial market, let's say you're looking at the chart for Bitcoin and you see exactly what I'm showing you right now, then it means the market is trending up. Very, very simple. So let's move further. Downtrending markets. This type of markets, financial market, is characterized by a series of lower highs and lower lows. Lower highs and lower lows. Very, very simple. Now you see this market was trending down. This market is trending down to this point. From here to this point, this is lower high, lower low. So market goes down, lower low, goes up, lower high. You notice lower high, this lower high was lower than the previous lower high. You see, this lower low was higher than the previous lower low. Market moves down from a lower low, here, comes back up, lower high, comes back down, lower low. This lower low is lower than the previous lower low. Why this lower high is lower than the previous lower high? So when you see a market moving in this direction or in this manner, then it means the market is trending down. That is how you define a downtrending market. Now, let me go back to the previous slide and show you something very important. Now, if you look at this very slide, you discover that when the market moves from here to its point, it forms a higher high for an uptrend. It comes down from a lower high, comes back up, that moves up, form a higher high, lower high, higher high, higher low, higher high, higher low. Now, this move from higher high to higher low is called retracement in the financial market. This move from higher high to higher low is called retracement, or you can also call it correction, or another name for it is also called pullback. Okay, then it moves again. This move is called impulsive move. That's the impulse. Then this move again is called correction, or you call it retracement. You say the market is retracing or is experiencing a pullback. It's the same thing. This move is impulse. This is correction. Now, if you look at it very well, this higher high is lower than the previous higher high. This higher high is lower than this higher high. This higher high is lower than this higher high. So when you see a market like this, moving in this series of higher highs and higher lows, it means the market is trending up. Very, very important. So that's the hallmark. This is what you're looking after. This is what you're looking for you to define a market to be an uptrending market. Now, from this, you can as well know when the market will trend up for you to enter in a particular position. For example, in this case, you will buy the market. Now, the question is supposed to be that, okay, after the market comes back from a higher high to a higher low, how will you know, how will you define that, okay, this market, this very point is the right point to, place your buy order? This is what I discuss with my student during mentorship section. So if you want to know that, then slide into the description below and contact me immediately for a one-on-one training, because it is your ability to know when this have already ended. You enter the market as you buy at this point. You know when this have already ended, you buy at this point. You know when this have already ended, you buy at this point. That is what gives an edge between the beginner trader and an advanced professional trader. So let's move further. So it's the same thing when you look at downtrend. It's the same thing. The hallmark, what you're looking after, is lower high. You see a lower low. You see a lower high, lower low, lower high, lower low. So you're looking to short the market at lower high. You short the market at lower high. You short the market at lower high, because it is believed that at lower high the market will fully retrace back up, and then the impulse will continue. That is the continuation of this very trend. So your ability to define when this move have ended, this very retracement have ended, and enter after this retracement to continue with the impulse is very, very important in trading. So that's for downtrending markets. Another market structure that you must take advantage of when trading or look out for before placing a trade is sideways or ranging market. This type of markets drift to the right, and it does not have any significant higher high, higher low, lower high, and lower lows. Why? Because of their neutral nature. It makes them, drift to the right. You can't define any higher high, higher low, lower high, and lower low in a sideways or ranging market. Now, when the market is consolidating, it's different from when the market is moving sideways. I will show you that also in a moment. Now, if you look at this very example here, you discover that there is no significant higher high and higher low, and there is no also significant lower high and lower low. All we see is that there is a distinct boundary, this boundary and this boundary. Okay, this boundary and this boundary. It defines the market drifting to the right. That's drifting to the right, and that means the market is moving sideways or is ranging. Okay, so in this case, it's very simple to trade this market, because if the market is moving sideways, drifting to the right, it means this was a strong resistance level. I talk about resistance in my other video. Ensure you watch that video to know more about resistance and support level in the cryptocurrency market. Then this was support level as well. So it means this level has been respected once, twice, thrice, and the fourth time. Okay, so if this level is being respected 4 times, it means when market will come back to this level again, it has a high probability of being respected and then to go back up. So what you do at this point is where you will buy the market. Why at this point you sell the market? Because if you look at it, the market have respected this level once and twice. But for simplicity and professionalism, you have to ensure that the support level, that is, it must have 2 touches. Then the 3rd touch is where you will place your buy order. And in the case of the resistance level here, it must have 2 touches. And the 3rd one is where you will place your sell order. That is, if you're trading futures or trading on margin and all of that. So if you have 1, 2, this is the first one. You don't count this one. If you count the first one, market goes up, comes back down, 1. It hits here 2. This is the first one for resistance, the second one for support level. Then it means when it comes back down to this level again, support, that's the 3rd one. When it's going back up, that is when you will place your buy order. Then this is second for the resistance level, that is 1, 2. Then you wait for the 3rd one on resistance before you place your short position. That is in case you are trading margin and futures, that is when you want to short the market. So you look at 2 touches, and then on the 3rd one, that is when you execute your trade. So these are the 3 main market structure that we have in the financial market. Number 1, I said the uptrending market, talk about downtrending market, and sideways market. Now let me take you to a live chart and show you example of BTC USDT and how the market played out in using different market structures. Talk about sideways, downtrend, and uptrending market. So this is live chart BTC USDT. This is BTC USDT. I want to go to what's happening today so you see yourself. Okay, now BTC is sitting at $34,869. Okay, if you look at this market, you discover that this is a good downtrend. Nobody will tell you it's a good downtrend. If you look at this very chart, the whole chart here, you see that this is a downtrend. Now, if you go on the 1-day chart, you may not see a downtrend. That is how market structure is. So it's specific to that very time frame that you're looking at. Okay, you can't define market structure on different time frame until it's the same. No, your market structure is specific to a particular time frame. That is why when you're doing analysis and a trader asks you which charts were you analyzing on, you must define the charts you were analyzing on, whether you're using D1, using H4, or you're using H1 or W1, or maybe as the case may be, you are a scalper, you may be using M5 or M15. So if you look at this very chart, you will discover that this was a high. So we call this higher low. This was a lower low. Market goes up. This is a higher, lower high. This is a lower low. This is a lower high. This is a lower low. This is a lower high. This is a lower low. Now, if you look at this again, this market moves up and could not form a lower low anymore. This is where, as a professional trader, you begin to look at the market very well, because since the market does not form another lower low, lower than this previous low, it means that the market may turn back up. That is, there may be a potential move to the upside. You can only define that when you've seen that the market have crossed this very level, and there are other technicalities, and you must also look out for other factors of confluence to verify and to confirm your trade. This was the last lower low, but market does not form another lower low again. We see market move back to this point, come back down, come back up, move here, and market starts consolidating at this point. We see a little consolidation. So we're looking for a breakout. Now, a breakout of this very level on H1 will signify for me that the market is going to ride up, and I am looking at this very level. Market to hit this very level. And then if it breaks this, then Bitcoin is going to ride up again to form a new all-time high. So that is how you define your market. Now, when you define your market like this, it will be very easy for you to trade. It is very easy for you to trade. So the first thing you do when trading any financial market is not looking out for candlestick pattern. Maybe you're looking at engulfing patterns, pin bars, and Rahami, morning star, evening star, and all those kind of candlestick patterns. You're looking at a particular chart patterns. No, the first thing you're looking at, you look out for is you have to define the structure of your market. Then you use the structure of your market to apply your strategy. Very, very important. Now, let me look out for an uptrending market. See, this market was trending up. We can use our trend line. I talk about trend line also in my other video. If you not check out that video, ensure you do that and learn how to draw a proper trend line. So if I draw this trend line, you see the market was going up. So the market was going up, and then you see from here, this was you can call this the beginning of the trend, this very particular trend, and the market moved to this point. So you call this a higher high. The market comes back down, call this a higher low. So from here, market moves straight again. We call this higher high, market comes back down, hits the trend line. You call this higher low. Market move up again, higher high, comes back down, break the trend line. That is, it invalidates the trend line and form a higher low here. And then market move from there. After that, we'll see markets, consolidate for a little while, and then it's moved down. Now, for me, once the market breaks this trend line, it's, actually send me a signal that the market is going to reverse, or there will be a deep retracement for Bitcoin. I talked about this in my group. So if you're not in my group, my general group, check in the description below and you will get the link there, and then join the group so that you'll be on top of the market. Very, very important. So this is an uptrending market. I said this is your higher high, and then this is your higher low. This is a higher low. The higher low here. We have another higher high here. We have another higher high here. Then another higher low. Another higher low. Another higher high. Another higher low here as well. We have higher high here. Then we have a higher low here as well. Now, if you look at it, now if this market does not move above this high, we can't call it a higher high. That is, if it does not move above this previous high, that is, after this has formed and is moving up, if it does not move above the previous high, you don't call it a higher high. It means there is a failed swing. We call it a failed swing in the market, although we're not talking about that. But anytime you see something like this, that's what I'm talking about. You see market form a higher high here, it comes back down. Now, for it to go back up again, it could not form a higher high from this point. See the market come back here and fall down. So this is not a higher high because it was not higher than the previous high. Take note of that. Then this also, you must ensure you define the market in this series for you to call the market an uptrend. Now, the question will be that how many higher highs and higher lows will you see, or will you identify for you to define that, okay, the market is already in an uptrend? Because if you look at it very well, if you enter the market here, the market have already been in an uptrend, so you are entering late. So as a professional trader, you enter the market in such a way that you are not coming late and you're not too early to enter the market. That is, you are not late entering or you're not entering too early. All of that is given in my mentorship section. So check in the link below as well, and you see a contact there and then WhatsApp Remit line so that you can get that very deep that will help your trading activity and your trading methodology grow very, very fast. Now, so this is what you must have to define before you enter the market. Very, very important. Now, the last one is sideways market. Look out for a sideways market. If you look at this market, it was going up, and after it goes up, the market, comes back down. This was a downtrend. This was a pullback, and after the pullback, we see the continuation of trend. This is what we call the Elliott wave pattern. So it corrects with the ABC the correction before the market goes up. I will talk about the Elliott wave pattern in previous video that I will do. So also ensure you check the channel for that particular video. So if you look at this very market, you see market was moving between these guys. It was just drifting to this market was moving sideways. There was no significant higher high nor higher low in this particular market. So how do you trade this market? You wait for one touch, second touch. You see this third touch is a good sign to sell the market. The fourth touch is also a good sign to sell the market. That's a short. Then the fifth touch is also a good sign to sell the market. Now if you look at this point, we did not see anyone. We just see a little slight rejection. We see 1, 2, and then 3. This was a good time to buy the market. Very, very simple. So when you see a market like this, this market is moving sideways. Now, for very, very important, the most thing you have to understand is when you are trading a market in a ranging condition, that is a market moving sideways, is always very important for you to be very, very careful, because there are sometimes the way you place your stop loss also determine the way, if the market shifts a little bit right down, and then stop loss hunting, and then the market is also going in a direction. So you must be very careful in placing your stop loss. Place your stop loss in such a way that even if the market spikes out, you will still have enough space for the market to comes back down and then move in your direction. So what I'm trying to say is you must give enough room for your trade to breathe, should in case the market turns back down before moving in your direction, because there are tendencies like that the market will turn back down and then move in your direction later, and it is still in a ranging condition. So that is that, guys. So thank you very much, guys, for watching. If you've not subscribed to the channel, ensure you do that, and then like the video. Ensure you check in the description below. If you're not registered on Binance, check in the description below. You see my link, and then if you want to contact me, check in the description below, and also you see the contact there, and you can reach me, and I will answer your question very, very correctly. And if you need a mentorship, one-on-one mentorship section, also contact me via the email or the WhatsApp line in the description. Thank you very much, guys, for watching, and I will see you in the next video.